Hey guys, welcome to the channel Market Uncharted. In today's video we are going to talk about a few things you should consider when investing in ETFs. So first of all, types of ETFs out there, just a quick review. We have stock index ETFs, sector and industry ETFs, geographic ETFs, leverage ETFs, inverse or short, commodities and currencies. This is important when you are trading and making sure you are diversified in the market. But first, be aware of these 7 things before investing in ETFs. Number 1, the costs could be higher. If you compare ETFs to investing in stock, then the costs are higher. The commission paid to the broker might be the same, but there is no management fee expense ratio for a stock. So always consider this. Make sure you compare several ETFs about the same topic to see which hedge funds charge you extra for the commission. Then you have low trading volume. Most ETF trading volume is low, so the bid-ask spread may be wider, meaning investors might not get the price they expected. Also, due to the wide bid-ask spread, the market price of the ETF may not correspond to the exact value of the underlying securities. Lower dividend yield. There are dividend-paying ETFs, but the yields may not be as high as owning a higher-yielding stock. This is partly because ETFs track a broader market and therefore have lower yields on average. Designed to track, not to beat. ETFs are designed to track index, sectors, commodities or other assets, which means the fund often won't outperform the underlying assets in the index. Another thing to consider for the passive investors. Tracking error. ETFs track an index should technically deliver about the same return as the index, but there can be a divergence. Tracking error is the difference between the return an investor receives and that of the benchmark the ETF is attempting to replicate. Hidden risks. Some ETFs contain risky derivatives that might not be obvious upfront. For example, leverage and inverse ETFs contain derivatives and other complex securities. Always pay attention to this one as well. And finally, ETF premium to the underlying value. Although this is uncommon and is typically corrected over time, the market price of an ETF may not always reflect the exact value of the underlying assets. This can lead to situations in which an investor might pay a premium for the underlying stocks or commodities in an ETF portfolio. So just a small overview of the best performing ETFs of the past decade. This has changed dramatically since the Fed stopped doing QE and started doing quantitative tightening. But SOX, iShares, PHLX Semiconductor ETF, as we know, the semiconductor shares are extremely important for the economy, for the future. They provide the essential chips for the electronic vehicles. Then we have XBY, the biotech sector, which is extremely leveraged, extremely for speculators, but still deliver really high returns. Then the Nasdaq Internet ETF with the major ones as we know, Google, Meta, Microsoft, Amazon, etc. Then just the simple Invesco QQQ Trust, which replicates the Nasdaq 100 with the majority of Apple, Tesla, Amazon, Google, Microsoft, etc. And finally, the information technology from Vanguard VGT, which kind of replicates the same as Invesco ETFs. So thank you guys so much for watching this video. Never forget, knowledge is not power, knowledge is potential power, execution is everything. And just like the markets, we will not rest.